Welcome to the Barometer Readings Monthly Conference Call. My name is Leslie, and I'll be your operator for today. At this time, all participants are in a listen-only mode. Later, we will conduct a question-answer session. Please note that this conference is being recorded. I'll now turn the call over to Ms. Sarah Petoskey. Ms. Petoskey, you may begin.
Thank you, everyone, for joining us today for the Barometer Readings Monthly Conference Call. And thank you for all of your support over the year. My name is Sarah Petoskey, Regional Vice President of Sales. Since our last call, markets have continued to work their way higher, and despite some recent consolidation, Brett's models remain constructive, with relative performance of sectors like industrials and consumer discretionary signaling positive leadership. With credit conditions remaining positive, we remain optimistic as we finish out 2013 and enter a new year. As always, our investment process allows us to focus on specific areas of leadership. We continue to increase weighting in the U.S. across portfolios, but still benefit from specific areas in Canada that have strong dividend policies and growth coming from south of the border. We are proud of our year-to-date returns. Year-to-date, all of our strategies have posted solid positive returns. Joining us on the call is David Burrows, President and Chief Investment Strategist. David will review the portfolio changes made throughout the year as we, 1, protected clients from rising yields, and 2, repositioned portfolios in productive areas of the market. He will highlight the global markets and sectors that we are currently invested in and discuss opportunities we see going forward. Also joining Dave on the call will be Cameron Hurst, Vice President and Portfolio Manager with Barometer, who will elaborate on a couple individual positions in our portfolios exhibiting positive catalysts. At the end of the call, there will be an opportunity to address any questions you may have. With that, I will pass it over to Dave.
Hey, folks. Happy holidays. I'm sure there's a few people who have been out for lunches today. We're happy to have whoever's there on the call. Let me just start out by saying thank you very much for a great year. We certainly appreciate the support. As a firm, it's been another good year for us. We've been fortunate. I think a year ago we were something like $2.2 billion. When we resigned from the CI mandates, we gave back about $700 million to take us down, I guess, to about $1.5 billion, and we finished the year here at about $2.5 billion. So we've had a very good year from a return standpoint. We've had a really nice year of inflows, and that's thanks to the really good relationships that we have with you guys. So thank you very much for that. We are trying hard to take the additional cash flow and revenue that we're driving in the business and put it back in to try and build the team. We recently made 2 great adds to the investment team. Jim Brennan, who joined us about, 6 weeks ago. And Jim is a career credit guy, fixed income guy, with a very broad background, which included a number of firms, including running fixed income at J.P. Morgan at one point. He's going to work with us and focus on high yield and is making a really positive addition to the team. He's been on both sides of the street. Paul Campbell joins us in January. He's just resigned as Director of Research at BMO Nesbitt Burns, and so he's going to bring a really solid add to the fundamental research side of the business. He was responsible over the 11 years he was at BMO for their focus lists, which they certainly had a strong reputation for, and I think he's going to be really additive to the analyst team, so he'll be coming over to run research. So a couple of great adds. I think that there's more to do over the next year. We want to keep on building on the team. We can't stress enough how important this whole team concept is, because while we have a number of different mandates, we do look at all of the ideas we look at across the capital stack, right from equity straight on down through the debt levels. And we do turn over some really interesting ideas that may fit in any one of the mandates that we run. So, I've got Cameron here today, and Cameron is really focused on helping turn over U.S. and global ideas. Again, we populate these portfolios from all of the various team members, and it's I think a good strategy. Everybody is focused on the process that we use. So what I thought I might do is just quickly talk about the year in review and just highlight a couple of we think were fairly significant shifts from a market perspective. Talk a little bit about some of the changes we made on the way through. I won't belabor that. And then maybe talk about what we see as it stands today and where we're positioned going forward into the new year. From a return standpoint, we're really happy. Equity mandates this year were very strong. Both of them long short up kind of 24, equity up 22, so good and strong. The main income mandates, the income advantage pool fund, that we launched a year ago, up 11% in year one, so very happy about that, especially given the backdrop of the change in interest rate backdrop was a really constructive thing. If we look back to the period coming out of the crisis, we all can identify with the fact that we were in a market that was very much a risk-on, risk-off market. And through that period of time, you had two real themes that were working. For the traders, that bought dips and sold rallies, the risk-on, risk-off thing worked in the equity markets. That's really not our focus. And through that period of time, we spent the majority of our time focused on the income strategy, which we thought really was timely, was one that was more consistent, less prone to these bouts of selling and rallies, more consistent, and really better suited to the psyche of our clients and probably most private investors as a whole, things that generated yield or a rising yield along the way with improving valuations. During that period, you had a very tight correlation across all asset classes, especially between things like commodities and equities. And so when people got bullish, commodities rallied, stocks rallied, virtually all of the markets were moving together, tightly correlated, very high correlation, not just market to market, but sector to sector, and certainly was a tricky environment on the equity side. About 12 months ago or 14 months ago, we started to notice a shift in that condition. You had commodity prices making it increasingly clear that the commodity cycle may be done. They started to diverge away from equities. Sector to sector, we started to see correlations come down. 12 months ago, we had 90% correlation sector to sector. And in fact, very close to 90% correlations market to market. And we started to see correlations market to market come down. So that happened to coincide with the beginning of a backup in long rates. What that said to us was market was beginning to work a little bit more on price discovery as opposed to being a policy-driven market. So certain markets started to outperform, certain sectors started to outperform, and the fact that the bond market started to sell off a little bit gave us some hope that, in fact, maybe economy is starting to get a little bit better, and that stock picking may get a little bit more fruitful. And certainly, we are not the type of a firm that buys dips and sells rallies. We look for clear themes with longevity that really give us good risk reward. And then we look for those companies within those groups that have had some kind of positive change taking place where we can get some kind of revaluation. So it shouldn't be a surprise that we've had a decent year on the equity side because you've had some PE expansion in the market. Correlations have been coming down all year. We exit the year here with correlations at about 55%. They've come down from 90%. And it's becoming a little bit more fruitful to be stock pickers and be more targeted managers. Certainly the income strategy has been consistent along the way because that has been some pretty clear leadership in the market. But we are in a market now where equities, have been more fruitful. In the income strategy, which most of you have used along the way, it was a year where it was important for us to transition as the bond yield started to back up. The interest rate proxies started to sell off. The things that had led the market for 3 years, like REITs, like pipes, like telcos, started to give up some relative performance. In our breadth-based models early in the year, we started to see rotation away, and we started to see rotation toward or breadth expanding in groups like the financials in particular, some of the consumer discretionary groups, some of the industrials. And so through the course of the winter, we really had to go through a very significant rotation in our existing pool, the high-income pool, which was invested previously in interest rate proxies, away from fixed income, away from the interest rates proxies, and to things that were a little more economically sensitive. When we look how we've exited the year, we sit here about 90% equities, very focused in sectors like consumer discretionary, financials, which include, banks, insurance companies, asset managers, and the card companies, and some energy. But when I say energy, it's more like energy infrastructure. And there are a few that have really outperformed the rest, like IPL and Pembina and Keyera. So as we come out of the year, the income portfolio is highly focused in things with dividend growth as opposed to high yields. I think we're close to 95% of our positions over the course of the year now giving us dividend increases. It's amazing, actually, as I'm sure you would agree. You turn on the TV every day, and there's another dividend increase, another share buyback being announced. And so we've been very fortunate to be broadly focused in that camp, and I think that's why we've been able to have a really good, solid return, despite the fact that things that were really income-focused had a tough year. So dividend growth has been the theme, generally lower payouts, but higher dividend growth, and we think that continues to be the case. If I look at the sector allocations, biggest weight by far would be, not by far, but the biggest weight would be energy, and that's a couple of specific energy names with production and reserve growth, like a Whitecap or Torque Energy, Crescent Point, and then the energy infrastructure companies. The biggest weight overall in the portfolio would be financials. About 13% of the portfolio would be asset managers, really specifically levered to an improving equity market. We talked this past week on BNN about CI. While we resigned from the funds, we were fortunate to buy the shares. They had a number of funds with strong performance. They were getting net inflows before really there were net inflows into equities. So they came out of a tough equity environment in a strong position. They've had something like $3 billion worth of new inflows over the course of the first 9 months of the year, and giving good dividend increases. IGM also is in that camp, and Gluskin Sheff, recent addition, when that block traded hands at $19, provided a good lift. Insurance, Sun Life, IAG, Manulife, Great-West. Interestingly, while they're Canadian names, situations that have very significant exposure to the U.S. capital markets and benefit from weaker Canadian dollar. Banks continue to be a big weight, about 8%, followed by a couple of the IT companies in financial services, which I'd include in there, MasterCard and Davis and Henderson. Below that, we do have some more economically sensitive groups, although they're small weights because it's an income portfolio. We've got some technology, we've got some specialty retail, we've got some leisure, some aerospace, and some industrials. So, income portfolio going forward, a little more equity-centric, a little bit more dividend growth focused, I think continues to be a great alternative for the fixed income investor or the bond refugee who maybe is not prepared to make the leap directly to equities. And we certainly continue to use this as a core for our direct clients because it does give them equity exposure without a lot of volatility. Right? At some point we will see correction, and this portfolio is built to be pretty resilient. Having said that, our work on equities is really constructive, more constructive than it has been really for many years. I think a lot of you have seen our presentation. We spent a lot of time talking about structural bear markets or secular bear markets, and the fact that we entered one in 2000, and we've had to live through a lot of ups and downs. Clearly the market in 2000 to 2012 was very different than the 20 years we saw before it. In the 20 years between 1982 and 2000, in many of the years you got PE expansion, so valuations rose through the piece. Through a lot of that period of time, correlation stock to stock fell. It was a stock picker's market, and you had falling inflation through that period of time. And so through that falling inflation and a weakening commodity cycle, consumer and technology sectors really led the market. And I think it's interesting that in the period from 2000 to 2012, you had virtually no years of PE expansion. You had a market that was tightly correlated to inflation. It was the hyper-cyclical stocks that led the market when equities were doing well in this risk-on, risk-off market. And it was a tough market to make money in for a lot of investors. S&P moved sideways for 12 years. Well, so now over the last 12 months, we've seen correlations coming down. We've seen the first big year of PE expansion. Of course, the press wants to talk about, is this a bubble? Well, at 15 times earnings, it's hard to say it's a bubble. And it looks like there's some legs to this. When we look at it through our lens, 53% of stocks globally are participating in this rally. Now, you know from our presentations that when we look at these breadth models, when you get late in the game in a rally, you could get to a point where 70 or 80% of companies are participating in a rally, a broad-based market rally. We're nowhere close to 70 or 80%. We're at 53%. PEs, yes, have expanded, but it's interesting. If you go back over the last 30 years, there have been 3 big years of PE expansion in the last 30 years. In each of those cases, the following year was a solid positive return for the market, so you got a second year of PE expansion. And in 2 of the 3 cases, the third year was positive. So while that's just anecdotal, just because we got PE expansion does not mean it's done. When we go back and look at falling correlations, yes, correlations have come from 90 to 55, but in the bull market between 1944 and 66, and the bull market from 1982 to 2000, by the time you got to the strongest point in the rally, you were at 30% correlations. So correlations can fall a long way from here. We spent a lot of time talking through the year about the relative valuation of stocks versus bonds. And unless you think we're going to get a huge backup in the bond market yields, the earnings yield in the S&P at around 7%. Gives us a very good risk premium over 10-year bonds at 2.8. So 4% risk premium pays us well to take that equity risk. A couple of other interesting anecdotal points. If you plot gold against the Dow, which Mark Darriott did at Cormark, a very interesting chart, plots it back over the last 100 years. We've spent from 2000 until the beginning of 2012 where gold was solidly outperforming the Dow. And over the last few months, the Dow has made a turn against gold. In other words, paper assets versus hard assets. That turn in the chart has happened twice in the previous 100 years. Once was in 1944 at the beginning of the secular bull market, 1944 to 66. The second time it happened was in 1982. The beginning of the secular bull market from 82 to 2000. So it looks as though we've moved from a risk-on, risk-off market with very high correlations to a market with lower correlations, a paper asset rally as opposed to hard assets. We've got consumer discretionary sectors leading the market. There's a very good negative correlation between consumer discretionary and commodities. When the commodity markets in a secular bull market, consumer discretionary tends to underperform, as they did for the 12 years leading up to this past year. This year, you got solid outperformance consumer discretionary versus commodities. No sign of a turn in commodities, and consumer discretionary continues to lead. So, you go back to the 1990s, and people talked about a bubble. Glenn Bernanke talked about irrational exuberance in 1996, 4 years before the peak in the bull market. So you hear people talk about bubbles in equities today with a 15 times multiple. I would say we're a long way away from that based on valuation, based on breadth models, based on correlations, and based on time. So we're quite constructive. Our breadth models are positive. Now, over the last 4 weeks, markets have marked their way sideways, leading into this Fed meeting we're going to get tomorrow. Lots of concern around tapering. If you think about the way the market reacted to the concern around tapering earlier in the year in the summer, market got a little bit sloppy. We've had all of a 2% pullback off the highs, leading into what is widely expected to be tapering tomorrow. I think the market appears to be set up quite well. So in our equity portfolios, while we do have, a financials weight, and while we do have some of the energy infrastructure, we are more focused on things like consumer discretionary and industrials. Consumer discretionary in the equity pool makes up about 28% of the portfolio. So this is a little more economically sensitive and is a big beneficiary of falling inflation. So that would include airlines like Air Canada and American Airlines, some of the auto component companies, and Cameron may talk about one today, but we have Magna, we've got Johnson Control, we've got Lear, we've got Linamar. Some of the web-based internet retail, like say an Amazon, or Demandware, which is infrastructure for internet retail. We've got a good solid exposure to the leisure sector, which would include Las Vegas Sands and MPEL, also Starbucks. And then we've got beyond consumer discretionary, technology is about 13% of the portfolio. That's software services and some hardware, specifically Apple. Financials about 12%. Transports are about 8%. And then a smattering of industrials, which has been a sector that we have steadily been raising our exposure to. From a relative strength perspective, industrials are gaining both in North America and globally. So that is a sector that we continue to look for ideas. We've got a little bit more exposure to that in our global portfolio. ETF portfolio, the key sectors are industrials at 22%, technology at 20%, consumer discretionary at 15%, financials at 13%. So some very clear themes in place, some have and have-nots. We spent 12 or 13 years talking about income, and we think that continues to be core to the portfolios. Boomers are not going to make the immediate leap from fixed income straight out the risk curve to higher beta equities, and we're not suggesting that. But we do think that there should be a bigger place in the portfolios for equities going forward. Now, in the 1990s, PEs rose all the way through. High relative strength stocks led the market. So relative strength is a great strategy, which, of course, is what we focus on. In fact, in our separate accounts that we run, our equity mandate was up a little over 22% a year in the 1990s. I think that we are headed back into that type of environment, and you'll probably hear a lot more from us on equities as we work our way through the year. So I've talked a little bit about the themes. We're constructive. We're pretty fully invested. We would expect that year finishes out reasonably well. We think the first part of the next year starts out pretty strong. I think that we're well positioned for it. We're not going to get too fussed about the last couple of weeks of trading because it's likely to be lots of noise as people square up their positions for year end. But what I wanted to maybe do is pass it over to Cameron and get him just to highlight a couple of the positions in the portfolios, not specifically because we think that they are the ones to own, but we want to just always talk about how we look at finding ideas and the things that drive us. So I'll pass it over to Cameron.
Great. Thank you, Dave. Good afternoon, good evening. I appreciate the time. So I thought, it makes a lot of sense to take all of the themes and trends that we're seeing and investing for and just take it to the one step further and give you a sense of how that lens then looks at the specific positions with which we populate the portfolio. So the first one that really checks all the boxes for us thematically and as a investment process is Johnson Controls, Dave mentioned. JCI is 2/3 auto exposure and 1/3 industrial exposure, commercial. So it does have a bit of a cross reference there on the themes, but what we really like about it is that this is a management who continues to rationalize the business on the auto side. They do have 2/3 exposure to this, so it is a nice secular tailwind from an industry perspective. They're focused in seating, interiors, batteries, and actually rationalizing some of the interiors business just to focus on the high-margin growth parts of it. On the battery side, to give you a sense, they just signed a 10-year deal to provide Tesla batteries. So they're focused on what areas of the market are growing. Seating is becoming increasingly important and more technical, and they're focused there. With autonomous driving cars coming around, your seat vibrates on the side as you get close to the lane to give you a sense of safety. So really well focused in the markets and the trends that we see. The company management's done an excellent job. Now, the nice kicker on this is also the one-third industrial exposure, because building controls and environmental efficiency have become increasingly important, as demonstrated locally here with the TD Centre upgrading all of their buildings. This is the part of the company that gets not only new buildings, so non-resi construction activity, but also refurbishing old buildings, just like the TD Tower. So, chances are if you walk into a boardroom and you take a look at the thermostat on the wall, it's going to be made by Johnson Controls. They're the leader in this area, have the lion's share of the market share, so they benefit from this upturn in the cycle. Speaking to the yield theme, they have a modest 1.7% dividend, but the management has committed to increasing it at the same growth rate as EPS, which is in the mid-teens. They just announced a share repurchase program, added $3 billion to it, so now that's a total of $3.6 billion that's in place, buying aggressively. So that's all 16% of the market cap that management has committed to return over the next 3 years. So it checks the growth box, it checks our themes, it checks the capital return and the yield growth, and fits into a lot of our equity portfolios in that regard. Now, playing off further on the industrial theme, and the next name is United Rentals, URI is the ticker. It's all industrial exposure, commercial industrial. There's no consumer exposure in this, so it's levered to the non-residential construction cycle, CapEx cycles. 90% of what this company does is equipment rental for construction. That can be anything from an excavator all the way down to a jackhammer, something down close to a $10,000 level. The utilization rates on everything, all of this inventory that has been rationalized through the downturn, is extremely high now, and what that does is drive pricing. So with pricing increasing, that feeds straight through great revenue growth, but importantly for this kind of a name, it also drives terminal value for the assets that they hold in inventory. So that's how you see that this is a very cyclical name, and as you see the non-residential construction cycle and refurbishment cycle start to kick in, which tends to be on average a 7-year cycle, we know that we're in very early innings. So your inventory is appreciating in value, your pricing is working for you. On top of that, having survived the downturn, management is extremely cost conscious, so they've committed to reducing costs by $250 million by the end of 2014. All that also means is that they're not spending to make this revenue happen, it's actually dropping to the bottom line. So this is the kind of company that can grow earnings in excess of 20%. Embedded in this segment also I would highlight is total control business. It's a new thing for them, and it's also a new approach for the whole industry. So what they do is on any piece of equipment of $10,000 in value or higher, they actually put a GPS tracking device. So the company management has the software to tell you what parts of your inventory on a construction site are in use and what's sitting idle. So if that forklift over there parked in the corner hasn't moved in 3 days, they can tell you. Effectively, what they're able to do is sell this consulting process because they can double your utilization rate for all the equipment that you're paying for just by running this overlay on your construction site. The revenue growth is over 28% year over year, it's margin accretive, and it's generating tons of cash. So they're taking a new approach to the business, which makes a lot of sense in an environment where people are very cost conscious, when the government is hardly throwing confidence at you with the DC shutdown. Companies are being very particular where they're putting their dollars, and these guys are not only renting it to you, but also helping you use it the most efficiently, making them the choice for the new construction. Lastly, they don't have a dividend, but they have just announced a $500 million share repurchase over the next 18 months. So again, while it is cyclical, it is a much higher beta equity position. It doesn't pay a dividend, but again, you see management being conservative, signaling to the market and investors things are going well, they're going to return capital when they can. So that's just shy of 10% of their market cap. Makes a lot of sense to us, checks all the boxes, and that's the type of position that you can see makes a lot of sense in an equity portfolio looking forward into 2014.
Good. Thanks, Cameron. So just before I wrap it up, I guess give you one more set of anecdotal points. I saw an interesting chart this past week that looked at household ownership of equities. So ownership of equities as a percent of net household wealth. And it's interesting how that ebbs and flows. If you went back to the beginning of the bull market in 1944, equities made up about 9% of household wealth. By the end of the bull market in 1966, that had risen to 30%. So a big increase, and it took a long time because people make decisions one by one, and by the end of a bull market, everyone's in the boat. At the bottom of the bear market in 1982, household ownership of equities had fallen to 9% of household wealth. Again, I got in the investment business in 1986, 4 years into a secular bull market. Ownership was rising, but still very low. By the time the great bull market of 2000 came to an end, equity ownership again accounted for 30% of net household wealth. So we know what's happened between then and 2012. 2009, equity ownership, once again, 9%. So I know markets have been better. I know that sentiment is improving slowly, for some clients more than others. Household ownership of equity sits at about 19%. So we're a long way from 30%. It's a long way from everyone being in the boat. That's not to mention pension funds who under-own equities. So whether we're looking at PE expansion, whether we're looking at equity ownership, whether we're looking at valuation, whether we're looking at Breadth models, all of these things point to a likelihood of a continued stronger market. Economic data is getting slowly better. We haven't had any change in monetary policy. The old adage was 3 steps and a stumble. So while we may get some market movement around potential tapering, market looks pretty prepared for it. So we're constructive coming out of this year. We want to wish you all a wonderful holiday, and we look forward to seeing you all in the new year. I'm going to pass it back to Sarah just to wrap up, but thanks for a great year.
Thank you again for taking the time to join us today. As Dave reviewed on the call, Barometer's flexibility in both the asset allocation and security selection decisions has benefited our investors this year, allowing us to add value beyond what many traditional Canadian equity or income mandates can. With our commitment to transparency, we will continue to provide you with frequent commentary, monthly conference calls, and the weekly holdings. And as always, please do not hesitate to contact Nick or myself with any questions. We look forward to having you join us on our next call on Wednesday, January 22nd at 4:15 Eastern Standard Time. Hope everyone has a safe and happy holiday, and we wish you all the best in 2014. We look forward to seeing you in the new year. With that, we could open it up for any questions.